George, would you wave your hand so people can see you, which one you are on the monitor? Thank you, George.
Buenos dias,
Okay.
amigas.
I'm not sure that plays well in Scotland and Norway, but go ahead and try it out.
Top of the morning to ya. Maybe that's a little better. Scotland and Norway, at least Scotland.
Good morning, Maury. Okay, we're going to have some folks coming in a little bit later. I know that for sure, but why don't we go ahead and get started this morning? And good morning, good morning, good morning. Even though we still got a couple of people going on Zoom coming in to the invite, we're going to go ahead and get started with the Regeneration series of webinars on the topic of the pandemic. In our series, we're in our 4th week, and the pandemic is in its 3rd month. So much has changed in the last 3 months. Our president was right when he said nobody was prepared, and that is the truth. We're actually fighting a battle on 2 fronts, the health of our citizens and the financial stability of our country. We're not only the leading economy in the world, we are the flag bearer for this thing called capitalism. And nothing represents capitalism more than New York City, and specifically Wall Street. Wall Street, the home of the New York Stock Exchange. And today we have a special guest that knows about capitalism, the New York Stock Exchange, and managing investments, including 401s, IRAs, and maybe most importantly, protecting your wealth in a highly volatile market. George Seay is the founder of Annandale Capital. George has an MBA, a law degree, and is a CFA. That's Chartered Financial Analyst. That's the degree that you want to have, or the designation you want to have when you're doing investments. He cut his teeth as a litigation lawyer with an international white-shoed law firm, but he didn't love practicing law. In fact, I'm not sure he even liked it. Love might be too strong of a word, but what he did love was managing money and helping individuals he felt had a long history, specifically of bad advice on investments. George is a regular guest expert on all of the national financial programs, including Your Money, Squawk Box, CNN, Fox, CNBC, and more, literally. Well, remember, the purpose of our webinars is to answer your questions. So if you have a question, either text me directly, and I will get it off of my iPhone, which is in front of me, or you can go to the chat function on Zoom, which is if you go down to the scroll bar on the lower, just go down to the scroll bar, you see chat, just click on chat and then type in your question. You can do that either privately, just directly so that only I see it, or you can put it publicly so everybody can see it. Okay, well, either way, just get your question to me. A few people did that last night. In fact, one I had a colorful conversation with yesterday. In fact, other than, according to at least people on the European continent, other than my haircut, I'm ready to go today. So George, are you ready to get started?
Born ready, Jim.
Okay, well, good. Well, let's get going. So let me start with a question that came in on a call yesterday. George, why are you doing this? Who are you, and why? I was asked a little bit comically, why George Seay and not Warren Buffett?
Well, thanks for the question. I found out about a couple of years ago that people who'd known me for 30, 40, 50 years didn't even know what I did professionally, because we tend to keep a very low profile, and probably none of your viewers, or very few of your viewers, have heard of Seth Klarman, although he's compounded capital at 20% plus a year with his $32 billion hedge fund complex out of Boston. So, there's some investors like Mr. Buffett who have created this avuncular favorite uncle persona, and they're on the TV all the time. And then there's others that keep a lower profile. And our client base tends to be high net worth individuals and families and small to mid-sized institutions. And they don't necessarily want their money manager promoting himself all the time. So we kept such a low profile. People who've known me all my life didn't even know what I did. And we've done a little more TV and radio and media lately, just so people know what our firm is. And who are you? I'm a 7th generation Texan. I have 6 children between my wife and I. We live in Dallas. I'm a 5th generation Dallasite. I did practice law for a short period of time, and that was not my favorite thing to do. I would work for the U.S. State Department for a while too in Washington, D.C. And I've been managing money for 30 years now, and I've had my firm for about 22. And we do all sorts of investments around the world. We do common stocks and public bonds, and we do private equity and hedge funds and venture capital and real estate, oil and gas. Basically, if you can invest in it, we do it. And we advise or manage on around $3.5 billion worth of capital for a lot of wonderful people. And it's a real privilege to protect their money and try to grow their money even in times such as this. So we love what we do, and we get rewarded for having our clients be successful and doing what's in the best interest of our clients. And that's another wonderful thing I love about our firm, is we have to put our clients first.
Thank you, George. So, George, you and maybe a few others on the call this morning know that I just passed my dissertation at the London School of Economics in behavioral economics. And that's the study of how and why people make decisions. And behavioral finance is a subset, or actually it's a discipline in and of itself, but it's very similar in that it focuses in on on financial decisions. Well, this is at the heart of every individual investor. Talk to us a little bit about today's market volatility and the individual investor and finance, behavioral finance. Wrap all 3 of those into one response.
It's a very, very important subject. We all have a lot of risk seeking behavior and are willing to take on risk until the market starts dropping like a stone. And then we find out really how much risk we all want to take on. And behavioral finance basically says that most investors, we all know we have emotions, and the 2 primary drivers of emotions in investments are fear and greed. And when markets are going up, people get greedy, and when markets go down, they get fearful. And it needs to be the inverse of that. And that's what makes behavioral finance so difficult, is you want to be scared to death when the markets are at all-time highs and super high prices, and you want to be licking your chops and really ready to put more capital in the public and private markets when stocks dive, because the prices are just less expensive. And to emotionally prepare yourself for that, and to resist your rush to flee when markets are going down, is just very, very difficult. And an investor has to be extremely disciplined to do that and take the emotions out of the equation. Recognize you have emotions. Recognize that when you buy stocks when they're way down, you're going to have a pit in your stomach. But to have a queasy stomach means you're probably buying at the right time, whereas buying when you feel giddy and euphoric probably means you're paying too high a price for stocks. And the statistic I would show for investors is that between 1998 and 2018, a 20-year period, the markets on average made about 8% a year. And that's through the tech bust and the Great Recession and a whole bunch of bad markets. And the market still made about 8% a year, a little below its historical average of 10% a year, but still a really nice return. But over that 20-year period, if an investor missed the best 10 days in the market, and best days in the market usually happen in bear markets because stocks typically have powerful counter trend rallies after they go down quite a bit. If you miss the best 10 days, so that's 1 day every 2 years in that 20-year span, your return goes from 8 to 4. I wanted to let that sink in a little bit. Your return gets cut in half if you miss the best 10 days.
Hold on a second, George. Say that again one more time in case anyone missed that. That's a fascinating statistic.
From 1998 to 2018, if an investor is in the market but gets scared and gets out and misses only 10 days, which is 1 day every 2 years over that 20-day period, miss the best 10 days, your return goes from 8% a year if you just stayed in the market to 4% a year. And if you miss the best 20 days, so that's only 1 day a year for 20 years, your return goes slightly less than 0 from 8%. So let that sink in. And the moral of the story on that is that you take whatever money you're comfortable having in the stock market, money that you can afford to take short-term losses on, money you don't need to pay your bills or to pay the expenses at your ranch or to fund your child's college education, things of that sort. Money you can invest for a very long period of time, and money that allows you to sleep well at night. So it's not like all your capital, or you borrowed money to put it in the market and you really get scared to death and can't sleep if the market goes down. Money you're comfortable having in the market. And for every investor, that's a different percentage. For some people, maybe an 80-year-old who's past retirement and maybe has a 10-year life expectancy, maybe it's 20%. For a super aggressive investor who doesn't mind volatility, maybe it's 80%, 90%, who knows? It varies for the individual, but keep that money in the market, because you can't predict how the market is going to respond. We've had several clients the past few weeks concerned about getting in or out of the market, and we quote them these kind of statistics to say the important thing to do is to pick the exact percentage you're comfortable having in the market and then just leave it alone. And if the markets get extreme one way or another, add when it goes down and maybe trim a little when it goes up too much. I think, Jim, you're muted. I can't hear you.
That's not always a bad thing, George. So I'm reading one of the questions that just came in. Investing in stocks scares me. I feel like I've been left out of the stock market gains the past decade. And now, I feel a little bit proud of myself because I stayed in cash. But I keep hearing the conflicting advice about cash and stocks. And so just react to this person's question, please.
Yeah, that's a great question. And I think it really reflects what we just talked about in behavioral finance, is that stocks are scary. And I think they're scary for most people. And anyone who tells you they'll give you a 10% risk-free return, run the other direction, because the higher the potential return on an investment, the greater the level of risk there's going to be. But the good news about the stock market is the longer you stay in, the more the odds are close to 100% that you're going to make money. And right now, cash is earning 0%. So that's the reality. Net of inflation, you're actually losing purchasing power of your money if you're sitting in cash right now. So almost every single investor needs to have money in the stock market. And I would agree with the questioner that right now is not near as attractive a time to buy stocks as 2008 and 2009 was. So that's kind of the circumstances we're in right now. But no one knows what the future looks like, and everyone should have something in the market. And I want to give another statistic that will sum this up pretty well. In 1987, which is 33 years ago now, and I don't know what age your questioner is, so this answer will vary for somebody who's 20 and somebody who's 50 and somebody who's 80. But if you've got 33 years to work with, like you would from 1987, the market opened up the day on Black Monday of 1987. Some of you all will remember that the market went down over 20% that day, in one day. And the S&P was at a level the Dow Jones Industrials were at a level of 2,500 that morning. They closed around 2,000 that day, which is a little over a 20% loss from where it started. If an investor had started the day fully invested 100% in the market, from that period of time till today, even with a large sell-off this year, that investor would have made 9 times their money in 33 years. Really 32 and a half years to be precise. If you had bought at precisely the bottom that day, so in other words, you were 0% in the market at the start of the day and you went 100% in the market at the end of the day, so your timing was perfect, you would have made 11 times your money. So my point being is the long-term investor in the market, it really doesn't matter when you get in and out of the market. You would have made 9 times your money if you had bought at the high. You would have made 11 times your money if you bought at the low. The key is someone just needs to put aside the amount of money they have that they're comfortable investing in the market and leave it alone. And let the power of time and compounded interest work for you, where when you get gains, they build on themselves over time. Now, an investor who's 80 years old and wants all their cash available to them, you don't have near the flexibility to invest in the market. So every situation is different. But over a long period of time, stocks really aren't that scary at all. The only question is when your entry point is, are you going to make 4% or 8% or 12%? And that does matter, but you're going to make money over time.
I see a nodding head from another learned professional in the field. I'm going to come back and call on Ben Fisher in a minute. But let me get to this next question. I think it's a beautiful question. It's actually a two-part question, but I'm only going to ask one. I'm going to save the other part. What about bank stocks? What do you think about bank stocks over the next 6 months to a year?
Oh, that's a great question. So every value investor in the world has loved bank stocks for 4 or 5 years, including Warren Buffett, who you mentioned earlier. And they've been stink bomb investments over the last 4 or 5 years. They've done very poorly. And the reason why is because interest rates are so low and they can't make good earning. Banks really make their money, as most of you all know, or at least some of you all know on the call, by paying a certain interest rate on the deposits that are held by their clients and then loaning the money out at a higher rate of interest. And their main source of profit is the spread between what they pay in interest and what they loan money out at. And with interest rates at zero, they just can't charge 10% for a loan, and the spread between what they can charge and what they pay has been narrowing. So that narrows their profit margins. Now, having said that, although I think banks are an uncertain investment over the next 6 to 12 months because they've been highly volatile and they're highly out of favor, back to the time element, if you go to 5 or 10 years out, most of the major banks trade below tangible book value and they pay very, very high dividends. So for a value investor who focuses on things about that, let me explain tangible book value. That's if you subtracted liabilities from assets, that's the net worth of the bank, the assets they hold and what the value of those are. And the stock price on many of them trades below that level. For Citigroup in particular, which is not the highest quality large bank, but it's one of the biggest, it trades markedly below tangible book value. Only the highest quality banks like JP Morgan, and I say highest quality just because it's the biggest and it's the strongest. I'm not necessarily endorsing one bank over another in terms of dealing with them. It's the only one I'm aware of that trades well above book value. Goldman Sachs trades below book value. I believe Morgan Stanley does. I think Bank of America does. I know Wells Fargo does. So if you've got a 5 or 10 year time horizon, I would buy a diversified portfolio of major market bank stocks and just forget about them for 5 or 10 years. But over the next 6 to 12 months, I'll be honest, I have no idea, because there are very valid, wise people on both sides of the argument. One, that we've seen the lows in the stock market and we're immediately going to go back up near the highs in February, which is just 2 months ago, believe it or not. And then there's people who say we're going to retest the lows, which is about 20% below where we are now, and we're going to penetrate them and go lower than that. And they both have rational arguments for that. So the next 6 to 12 months, I really don't have a high level of confidence. You go out 5 or 10 years, my confidence level is close to 100%.
So it's really interesting that in the last recession, depression, worldwide global economic downfall, the banks were truly out of favor at that point. And now we're looking at another one where there's questions about whether or not, because they're handling so much activity through the PPP and the CARES package and such, that they will be active and involved and, a good investment. So I see somebody, Ellie is waving her hand. So Ellie, do you want to ask, if you wave your hand, I'm going to call on you and you can ask your own question. So Ellie, please.
Hey, George, good morning.
Good morning.
Just a quick question on cash position. Of course, so many of the businesses that we work with are doing their very best to conserve cash right now. If you could speak to that a little bit and best ways that they can do some of that, but also how do they raise capital wisely right now?
Raise capital from outside investors, or raise capital out of the market, or where would the capital come from?
Even from their own investments, how do they do that without taking a big hit? How do they decide where to pull money from, potentially outside of, just how can they go about raising capital during this time?
Well, let me phrase that probably most of our clients are fairly moderate to conservative investors. So we tend to structure their portfolios like that, pretty moderately to conservatively. We have a few aggressive investors, but not a whole lot. I'm a pretty aggressive investor when I deploy money. I do a lot of private equity. But in terms of our company, we're very conservative, and I would encourage everybody on the call to be the same with their personal or professional finances. So if there's small business owners or mid-sized business owners on the call, I would have at least a year's cash on hand right now to weather these hard times, because we really don't know what's coming in the future. And from a personal standpoint, I would have at least a year's cash on hand, maybe two. We just don't know if this thing's going to last another 3 months or another 3 years. That's probably the relevant range of time. And I hope and pray it doesn't go on for 3 more years. But I think it's a good time to be conservative. And in terms of raising capital, those folks who need to raise capital, I'm not encouraging them to do this if they don't need to, but if they do need to raise capital and they hold a lot of investment grade or AAA Treasury securities, bonds, now's a pretty good time for those securities that have appreciated in value to go ahead and liquidate them and hold that money in cash right now, because bonds are yielding so little right now that there's very little additional capital gains that would come from a bond portfolio. So that's a very good source of cash for people, especially with people who have 10-year treasuries or 30-year treasuries or long-dated bond investments, because they're not likely to appreciate further. In terms of the stock market, it really depends on the investor. Let's say an investor is super aggressive and has 100% of their money in stocks. Well, we just got a 25% rally from the bottom. So right now is probably an excellent time to take a little money off the table if you need some extra cash cushion, because you don't really need to be 100% in the market right now. Everything's so uncertain. If an investor is 20% in the market and your securities have rallied significantly, but 80% of your money is in non-equity investments, I really wouldn't sell any equities right now. It really depends on individual circumstances and how much cash someone needs to raise. So I hope that helps.
It does help, George. Thank you very much. And so on this call, we have actually a national kind of a leading bond specialist, Ben Fisher. And I just would like to ask Ben to comment on your position. Ben, where do you see bonds at this moment? You have to come off of mute, Ben. Okay, try it again.
I can't do it.
You're good. You're good.
Am I good?
Yep.
Okay, well, I couldn't agree with George more. I think bonds are probably a good source of funds. I am intrigued by the people down in Austin, Van Hoisington. They think that there won't be inflation, and I think they're still bond managers who have a great record and still think bonds are going higher. And they're very frustrating to me because they've been right about inflation for so long. They've generated one of the best records in the country. So I tend to believe like George does, but I guess there are people like Van Hoisington that are somewhat in the other camp, for whatever that's worth.
Okay, thank you. I may come back to you in a minute, Ben, but I want to get to Joran. Joran?
Can you hear me now? Can you hear me now? Can you hear me now?
Yes, we can hear you fine.
Okay. George, I just going to follow up. You already partially answered my question when you answered Ellie about bonds. Is there reason to buy any bonds at this time, or should we, or is all the reasoning we should actually mobilize capital by selling bonds right now and buying stock?
That's a great question. It allows me to follow up on what was said previously too, which is I'm familiar with Van Hoisington. His son was a fraternity brother of mine at UT years ago, small world. Van has been right for about 20 years. Basically, the Treasury market has been in a bull market since 1981 when Reagan first became president, and Paul Volcker, who was the Federal Reserve Chairman at that time, raised interest rates through the roof, and interest rates have dropped ever since. But the 30-year Treasury was around 15%, and the 10-year Treasury was around 17, 18%, if you can believe that, in 1980 and 1981. And today, the 30-year Treasury is about 1.3%, and the 10-year Treasury is around 0.6% as a yield. So, you know, unless we go into a negative interest rate environment, which is certainly possible, there's very little appreciation in these securities left. So anyone who's betting, and that's what it is, it's a bet that these go to zero or negative, they're really kind of gambling at this point. They're not really investing. So, if I have to sacrifice earning 0.5% versus holding cash and having complete option on what I do with my money, I'm going to cash right now completely. And in terms of bonds for investing right now, I think investors are going to make the mistake, many investors, of looking at what are called junk bonds or non-investment grade bonds, because the yield on those has exploded over 10% in the last month or so as the market has fallen apart. And everybody goes, wow, I can get 10, 11, 12% on these non-investment grade bonds. What a deal. The problem is when they blow out like that, from a yield standpoint, it shows distress. And we all know there's a lot of companies out there in complete distress right now and are at risk of really getting hurt or even filing bankruptcy in the coming months and years. And you don't want to own a bond, especially an unsecured junior piece of paper on a bond on a company that has the chance to go bust, because you don't want to go through a bankruptcy process. So I would be very, very against chasing yield right now in public bonds. One strategy we are pursuing in the private markets, where it's kind of easier to find inefficiencies, is buying bank debt from banks that are trying to offload their exposure to certain sectors and companies. And why I bring that up is usually banks, and we talked about bank stocks earlier, bankers may be your friend when you've got a lot of cash and you've got a strong balance sheet, but they're definitely not your friend when your finances turn against you. So banks are usually the number one person in line to get paid if a company goes south or an asset goes south. So we're investing with some very, very savvy people who are trying to buy bank debt from banks, who are trying to clean up their balance sheets and buy bank debt at 60, 70, 80 cents on the dollar with double-digit yields on companies or assets where you're covered, or your collateral, what secures the debt, is 2 to 4 times what the value of the debt is. So if everything goes wrong, even if the world seems to come to an end, you can sell that asset and pay yourself back easily. So we're looking at some strategies like that, but you really can't do that in the public markets very well. So I would really encourage people to be super cautious with bonds right now. And I think cash is more attractive than bonds, personally, unless you're a professional bond investor.
Well, that falls right in line. And I'm also interested to hear what, Ben, you might comment. Got about 6 questions on bonds right here in front of me. So rather than just continue to beat the bond question up, let me just read it. What one person says is, bonds are supposed to be the safest place to put money, and yet the funds are paying such a ridiculously low dividend. It almost seems like it's not worth it. After management fees, I get 0 to a negative return today. Comments?
Yeah, that's just exactly what we've been talking about, is that you're really better off holding cash than bonds right now, unless you have a very short duration bond portfolio. For all our clients, the bonds they hold have a duration, which means the average time to maturity of about 2.5 years. So they get paid off very quickly, and they're investment grade, which means they're very high quality bonds, and they're extremely unlikely to default. And there's hundreds of these kind of bonds in those portfolios, and they yield about 2%. So you make a little bit of a yield, which is better than holding cash for that part of the portfolio that's in bonds. And bonds are a good safety play to offset the volatility of stocks.
Mm-hmm.
So that's the only way we're doing bonds. With that cash, it's nice to sit on cash right now and wait for really cheap deals in the market. I saw someone kind of default to the age-old strategy of, bonds are so low yielding right now. What I'm going to do is I'm going to buy high dividend paying stocks as a bond proxy, as a substitute for bonds. And they specifically pointed out AT&T and Verizon and some of these other companies that pay an extremely high dividend. I would caution everybody on the call today about that, because that is a pretty good strategy. But AT&T stock is about 30 today, maybe 29, and it was 38 2 months ago. And there's no law that says AT&T stock can't go to 20. So your 7% yield on AT&T stock, or 6.5 or whatever it is today, doesn't look so hot if you go from 30 to 20. So don't fool yourself in thinking that you can put together yield portfolio of dividend paying stocks that's just like bonds. It's much riskier than bonds. It may work out, but then again, it may not. And if I was to encourage people to look for yield in the stock market, and I want to preface this by saying this carries a lot of risk with it because oil and gas has been just slaughtered over the last 2 months. But pipeline companies that move oil and gas around are kind of like toll roads. They charge a fee to push the oil and gas through those pipelines. And those companies have come way off in price and they have very significant yields. So that's a pretty good place to look for yield. And then the major oil and gas companies, the only ones you can almost be certain in the upstream, the people who drill for oil and gas markets that are going to survive are the big majors. And they not only drill for oil and gas, they move it around, they refine it, they're soup to nuts. And they're going to be a necessary part of the energy framework for decades to come. And what I'm talking about, and I'll be specific, is some companies like Royal Dutch Shell, which has been around for 100 years, British Petroleum, Chevron. They pay very, very high dividends right now. They've all confirmed they're going to pay their dividends, and they're all trading at historically low prices. So if someone was to try to substitute bonds for a dividend yielding portfolio, I'd strongly recommend they have a very diversified portfolio of 20 to 30 stocks. So when the inevitable happens that 1, 2, 3, 4 of these companies cut their dividends or eliminate their dividends or fall into hard times and the price goes down quite a bit, you're offset by other companies in the portfolio. And I'll also add one more thing, and I know this answer is pretty long, but one other thing I'd add is that right now we've just seen a 25% rally off the bottom. So you don't need to be in any big hurry to do something like this right now. Maybe the market just goes straight up from here, but I bet against that. I would think that the next 3 to 6 months, we're going to see more volatility, more to the downside than the upside.
Okay, we started out with kind of a bond question, so kind of quick answer on this. Ben, do you have anything you want to add that would be unique? George, good overview of that. So,
you hear me okay?
yes.
Okay, actually I have a question. I agree with all the wisdom that George is giving us. But there is a debate about what happens to inflation. If inflation starts to go up because we're essentially printing money, then bonds look really bad. But if Hutcheson is right and deflation is with us for a long time, that's their thesis on bonds. And the reason I bring this up is because in 2008, 2009, the price of gold started to rise because everybody thought we were going to have inflation. Went to about $1,900 an ounce. Then we didn't get inflation, gold collapsed. Well, now the price of gold has gone from about 1,000 to about 1,700 per ounce because everybody thinks we're going to get a replay. And I just wondered if George had some thoughts on inflation and, what happens to the economy as the Fed prints this enormous amount of relief money.
Well, I appreciate the compliment and the question both, and I'm glad to have an expert on bonds on the call because I don't claim to be an expert on bonds. I know enough to be dangerous as a professional, but it's not my specific area of expertise. We in our firm have tried to pride ourselves on everyone being a generalist to where we can cover all parts of the markets for all our investors. And we've got a really, really nice track record on bonds, but I don't do that 24/7, 365 days a year. So I appreciate the compliment. The inflation question, there's several things in life that have proven to be impossible to call correctly. And one is the weather, and one is interest rates, one is inflation, and one is commodity prices. They're just super volatile and they're super difficult to assess. And I would say there's a lot of people super smart in the bond markets that have been calling for inflation for ever since the Great Recession ended, because we had so much monetary stimulus and money printing by the Federal Reserve since then. And we got the opposite. We got an inflation rate that averages about 1.4% roughly, which is below the Fed target inflation rate of 2%. And now I've seen in the past couple of days with this, we're printing money and the Fed's being more aggressive now than they were in the Great Recession. And they did it a lot faster. So you see a lot of articles calling again for massive inflation going forward. That just hasn't happened. A lot of people, including Mr. Hutcheson, I would assume, have been calling us the current version of Japan. Japan has had zero interest rates for about 20 years now, and their economy has grown at a very slow rate since they kind of crested in 1989. And so far, our pattern looks a lot like that. So if I had to guess, and that was all it was, I would guess in the near term, Mr. Hoisington is correct, and interest rates are going to stay increasingly low and not go anywhere. But I wouldn't want to make that bet, because to your point, anybody who's investing in bonds, who goes very long bonds and has a very long duration, because when interest rates go up, if your duration is longer, you take a bigger capital loss than if you're very short, because you get paid back quicker that way. You could lose 10, 20, 30% of your money and be stuck on those bonds if we do have inflation and rates go from like 1.3 on the 30-year bond to 4, or even 40% with a move that extreme. So I don't want to make a bet on that. I tend to agree that we're probably going to have low interest rates for a long time to come and low inflation for a long time to come. But that's, like I said, like trying to decide what Texas weather is going to be 15 minutes from now. You just don't know.
Got it. It was freezing yesterday morning. It's going to be 80 today. So
there you go.
All right. Here's a fantastic question. I kind of chuckle at this one, but let me read it to you just as it is. What about moving stocks around? Last couple of days, my agent has been selling some and buying others. I'm not moving any money in or out, just shuffling stocks. Is that wise?
Gosh, that's such a great question. I can't speak to the particular investor or broker involved who's buying and selling the stocks. What I would say is that when you, Gretchen, you want to say hi?
Hello.
My wife just walked in, so I got distracted because she's so pretty. I had to look. So anyway, I want to point a couple of things out about this, which are important. Rebalancing a portfolio and changing the composition based on changed circumstances is a very wise and important thing to do occasionally, not much. You'd like it to be as tax neutral as possible, so you don't incur capital gains tax when you do that. And there's a widespread practice in the brokerage industry, and I'm not saying that in this particular circumstance this is going on, but it's called churning an account. And that's when you trade an account excessively to generate brokerage commissions and get the broker more money on an account. And like I said, I'm not saying that's going on in this instance, but investors should all be very careful about the big wirehouses. And you know the names of all of them, so I won't say them, but the big banks and the big investment companies, some of them still get paid commissions for trading stocks, so they're highly incentivized to trade stocks as early and as often as possible. And the major competitors to those firms, which are the independent houses like Charles Schwab and TD Ameritrade and Fidelity, just moved stock trading down to zero. You don't get charged anymore when you trade stocks, no matter what the size of that is. And we're an independent registered investment advisor, which means that we are fiduciaries. We have to put our clients' best interests ahead of our firm. It's a legal standard that we have to adhere to. And we custody at Charles Schwab and Company because they're a AA credit. They're very safe and they manage $4 trillion in assets. But Schwab has no role in the investment function. We handle all that. But our clients trade stocks for no cost whatsoever. So I would just watch that really carefully, and I would ask polite questions as to what the thinking is behind that, and if it makes sense, and if it's tax neutral, that's probably a good idea. But if it's excessive and generates excessive capital gains tax at such a volatile time, maybe not so much. Warren Buffett jokes that the best holding period for a stock is forever. And, General Electric in the last couple of years has proven that a forever holding period actually doesn't work all the time. But if you have really, really high quality companies, Microsoft, Apple, Johnson & Johnson, Google, Amazon, Royal Dutch Shell, things of this sort, you do want to hold those as long as possible so you're tax efficient.
George, I want to come back. We've got a question from the Southeast. Just clarification. Did you just say that it's only going to be the majors in the oil industry that are going to survive this volatility?
No, if that came across that way, that's not what my intentions were. My intentions were is that the oil and gas industry is so distressed right now that investors don't need to reach for the more risky investments to be successful in oil and gas currently. You can do just fine going out 10 years by buying the strongest, safest, best companies there are. There's a lot of independent producers in the Permian Basin and in the Marcellus Utica gas play in the eastern U.S. that balance sheets are not super strong, and they may survive and they may not. And if you want to invest in companies like that, I would suggest doing that through a professional or buying the senior secured debt of those firms that are currently yielding way over 10% because there's so much risk, and you're more likely to get paid in full and earn your interest if you're higher up in the capital structure, and bonds are always more secure than stocks in the capital structure. A lot of times when a company goes bust, the stock goes to zero and you lose all your money. So I'm just advising investors to stay away from those kind of companies. And let me give you some specific examples of companies that I would be highly inclined to look carefully at. And that would be, like I said earlier, Royal Dutch Shell, Chevron, British Petroleum on the integrated side that are the biggest companies in the world, and they're going to be around for 40, 50 years to come. And on the pipeline side, the companies that move oil and gas around and they get paid a toll, and most of their counterparties that are their clients are Exxon, Chevron, British Petroleum, the strongest companies out there, and they're likely to hold to their commitments, are companies such as Williams, which has the kind of the largest natural gas pipeline going up into the east there is, and Kinder Morgan, which is headed by Rich Kinder, who's worth about $10 billion in Houston, and Enterprise Product Partners, which is also out of Houston, and it's owned predominantly by the Duncan family, which has about $15 billion of their own money in the stock. And all those stocks yield anywhere from like 8 to 15% right now, and they're going to be here for a long time to come, and they're going to pay you a really high dividend while you wait, and they're very strong financially. And you know, the biggest tell of whether a really believes in their company is whether they buy the stock. And there's lots of reasons to sell a stock. Some of them are scary and some of them are just normal, like you're going to buy a vacation home or you're going to pay for your kids' college education. But if an insider buys stock, there's usually only one reason the insider's buying the stock. They think it's going up. And whether it's Rich Kinder with Kinder Morgan, he's bought about $300 million of his stock over the last year. Whether it's the Duncan family, he's bought around $40 or $50 million of their stock over the last year, or whether it's Kelsey Warren of Energy Transfer, that one's a little riskier because he has a lot more debt, but he's probably bought about $150 million of his stock the last year. Those are big votes of confidence that those are strong companies that are going to survive and they're going to do well going forward.
Thank you, George. So I've got a great question that came in from a great couple in New Jersey. What caught me by surprise was George mentioned to sell in an up market. We typically don't hear this from our money manager, especially during a bull market. The idea is to leave it invested and let it grow. Is there a rule of thumb on when to take some profits?
Well, let me give you an example I have on that I think an example would be best than me speaking in the abstract. We've got a client who almost never sells stock, and the client is almost 80 years old and has been a client for 22 years now. And what we try to do is set up an allocation that fits the client. So someone who's 20 years old and has their life completely ahead of them, and you know, they've got a nice investment pool and they don't need to access it anytime in the near term, they probably should just stay 100% stocks and just leave it alone until they get much older. But someone who's 77 and has a target allocation of 60% stocks and 40% bonds, well, this particular client's investments have done so well over this bull market that they got more like 65, 70% stocks. And that's above their target allocation. So for the last 4 years, we've been trimming a little bit to get back to the target allocation. So we might sell 2% of their stocks or 4% of their stocks. Try to keep closer to 60% stocks than 70% stocks. Because in my mind, somebody who's 75, 80, 85, 90 years old, unless they're worth $1 billion, and it doesn't matter if the stock market goes down 40%, they have no rational reason to be holding 80, 90, 100% stocks. You want to make sure the allocation fits the client well and rebalance to keep that allocation fairly close to the target. And to me, you talk to the client on a regular basis to make sure that target is right where it should be. So that would be the reason to trim in up markets, but only trim in the up markets. You don't want to sell in a panic when stocks are going down. When stocks go down, typically an investor's stock allocation will fall below the target. And then you rebalance to get back to the target, and you add stocks when stocks are going down, and you trim them when they're going up if you're way apart from your allocation. If you're close to what the perfect allocation for that client should be, whether it's 100 or 80 or 60 or 40, you just leave it alone.
Okay. George, I've got several. We're not going to get to all the questions, but keep them coming, and I can try to lump them together with some other similar type questions.
Jim, I'll stay around as long as everybody isn't sick of me, so I'll just keep them coming.
Okay. Okay. So we hear this term, and this is a pretty sophisticated group of people on the call. So, but not everybody understands, what does it mean to diversify? And why is diversification so important?
Oh, that's a really good question. I'll try to keep it succinct so I don't bore everybody, but there's multiple layers of diversification. There's diversification within an asset class. So that's like in stocks, for instance, you might have domestic stocks, international stocks, emerging market stocks, small stocks, mid-sized stocks, large stocks, value stocks, which are typically known for being less expensive and less risky for that reason, growth stocks, which tend to grow faster but have a higher price. And academic research has showed that the benefits of diversification pretty much go down to 5 or 10% or not as much anymore once you get to 25, 30 stocks, as long as they're across a whole lot of different industries. So the bottom line is you want to own several funds to diversify across managers, or at least 25 to 30 individual stocks in a portfolio, if not 50 to 100, depending on what the right number is for an investor, to make sure you're diversified across the size of stocks, the industries the stocks are in, the geographical sphere of influence of that stock, so that you've got a very broad-based exposure to the stock market. You also want to do the same thing in bonds. We have kind of a bias in our firm that you don't want to have a laddered bond portfolio because you're very stuck with those specific bonds, and most individual investors or even small institutions have to buy bonds to get any kind of reasonable efficiency, anywhere from 100,000 to 250,000 per bond. And very few people have enough money to build a bond ladder over 10 to 20 bond securities like that are diversified enough. So we tend to like funds better, because funds that have a track record of beating the bond indices, you can find them out there, and they typically outperform a ladder because they have the flexibility to go in and out of bonds. If a bond investor who has a ladder has to sell their bonds, they're typically going to get scalped by the broker who sells the bonds, because the bid-ask spread in stocks is razor thin, whereas the bid-ask spread in bonds is huge. So what you get price-wise for your bond and what they sell it to somebody else for is going to have a huge gap, and you're not going to get a really great price. Whereas a bond manager that owns $200 billion worth of stocks, his spread with bonds is going to be super tight. So you save more money being with a manager than you do having a bond ladder. But you want to be diversified across hundreds of different bonds as well. And you want them to be on average investment grade, so they're safe. You don't want to take credit risk in bonds. You want it to be safe. And then you can diversify further by having real estate assets, whether it's private real estate or real estate investment trusts on the public market, oil and gas. And we typically recommend our clients to do oil and gas minerals, which is buying a real property right and earning income off of that, which is pretty safe. And then the midstream stocks I mentioned earlier, which are safer and have higher yield. And then you get into private equity, owning operating businesses of private investments. You get into venture capital, which are startup businesses. And you get into hedge funds, which I've kind of lost enthusiasm for because the fees are so high and they underperform the public markets over a long period of time. But basically, bottom line is you can diversify across asset classes such as stocks and bonds, and you can diversify within the asset classes and buy different forms of stocks and different forms of bonds. And you don't want to tie yourself in a knot by being so diversified you kind of diversify out any chance to outperform, but you want to be diversified enough that if anything goes really bad, let's say the stock market goes down 50%, well, your risk is offset by your bonds and by your private investments that don't drop 50% when the markets go down like that. So the more diversification you have, as long as you understand it and are comfortable with it, the safer you'll be in your investments.
Good. George, what about real estate? Is real estate a safe haven today?
The short answer is no. I would be really, really careful with real estate right now. You're seeing all over the place that the hot dot in real estate the last 10 years has been apartment buildings, multifamily. And, you know, in the lower ranked multifamily apartment complexes, you're seeing people refuse to pay rent and demanding tenant rights on their ability to pay rent and waive rent for months to come. And in office buildings, you're seeing lots of companies refuse to pay office rent. And in shopping centers, you're seeing shopping center tenants refuse to pay rent. The companies that own this real estate are not immune to a lack of cash flow. And the dirty secret of real estate, it's important people understand this if they don't already, is that the average return on real estate over 100 years is around 7% per year, which is better than bonds, but not much better. Bonds on average earn about 6% a year over that same period of time. The way you see all these huge returns in real estate is that real estate investors are kind of known as cowboys as a caricature, just like oil and gas investors are kind of known as cowboys. And what I mean by that is they try to borrow as much money as possible to buy real estate, because real estate is such it's such an expensive asset class, because they're such big projects that it's really hard to buy a piece of real estate with all cash. You have to borrow a whole lot of money from the bank. And a conservative allocation to a real estate project would be 50% cash and 50% debt. But a lot of real estate investors will take as much debt as they possibly can and have 70, 80, 90, 95% of their investment paid for by debt. Now, interest rates are super low right now, but if all your tenants start defaulting, your ability to service your debt and pay back your lender that's lent you the money to own the real estate asset goes down precipitously. So long story short, Jim, I would really advise people to be careful about real estate right now. We were pitched a deal recently to a client of ours to do a $35 million raw dirt development out of state that involved a lot of hotels and restaurants and recreational facilities. And we politely urged the client not to move forward, because what is the hotel industry going to look like in the next 5 years? And what's the restaurant industry going to look like? It'll recover, but will it be the same as it was 2 months ago? I don't think so. I think the next 2 to 3 years, people are going to travel a lot less and they're going to eat out a lot less. And somebody's got to hold the real estate that owns the hotel and owns the restaurant. And so be super cautious about it.
George, not to be combative with you, but if you live in my household and you've been eating my cooking, trust me, the restaurants are going to do fine near where I live. No question about that. So, all right. So let me get to kind of a lightning round of questions, and I want to actually offer to Ben Fisher before I get to you, George. Ben, what's the market look like? Lightning round. What percentage can we expect out of investments over the next 3 to 5 years?
Predicting the market is impossible, but I would say that I've seen in my career a lot of bottoms. I saw the 74, 75 bottom. I saw the bottom in 2003, the bottom in 2008. And I think this is a similar bottom. So I think the chances for us to rise over the next 5 years, as George has said, are quite high. So I'm very optimistic. But predicting the market, especially in the short term, is absolutely impossible. But psychologically, this seems like the worst puke that I've ever seen in a market. And so from that point of view, I think behavioral science would say we should go up.
So did I just hear you say this is the worst puke you've ever seen?
It is the worst puke. Yeah, I've never seen so much.
Okay, good.
Margin calls and derivative. We've had several derivative firms go out of business. They were short volatility and got blown out of the water. The reason that JP Morgan and other banks are making so much money on their trades is they were taking the other side of these short volatility trades. There's nothing more than just an absolute gigantic margin call, and that's why the market collapsed.
George?
But
what do you
every
say?
time I've seen that, it seems like
Ben is spot on. I'm a big data guy and fact guy, and the old cliche of trust in God, all others must bring data to be believed. So Ben is exactly right. The February to March decline is the farthest the market has fallen in the shortest amount of time. The Dow went down 35% in a month. That's unprecedented. It didn't even happen in the Depression. Now, having said that, a 35% decline is not as severe as 2007 to 2009, where the market went down 50%, 57% at the intraday low, or 2000 to 2002, where it went down 45% at the worst, or 73, 74 that Ben mentioned, where the market went down in the 40s. The worst decline of all time was 29 to 32, when the market went down 82%. And I would just add that I would be just thrilled for most people who are in the market right now if we were done with this decline. But typically bear markets last about 18 months, and we're 2 months into this one. Technically, we've recovered and have moved into another bull market because we rallied over 20% from the low and are now down less than 20% on some indices than where we were at the bottom. But if you believe that this volatility is over and we really are done, I've got some beachfront property in Abilene I'd like to sell you too. So I think we're not done with the volatility, and I really would be shocked with how aggressively the Federal Reserve has moved if we get anywhere near the Great Depression level of decline. It's only been twice in history that the market's gone down 50% or more. So your odds are pretty good. You're not going to go down more than 50%. But I think people should have dry powder in place to put to work in the market. And I agree with Ben. I think the market will be positive the next 5 years. But I have very conservative expectations. I would expect the market with a ton of volatility to make an investor about 5% a year. And I think bonds are going to make around 1% to 2% a year. So everybody's just going to have to get used to the new normal, which is probably lower returns in the public markets. Okay,
good, George. So we've got too many questions to continue on, so we may come back to the part two continuation of this conversation at another date. But I do want to say a couple of things and then give you the closing word on this, George. Diversification, several questions about bonds, diversification. Diversification, summarized simply, you've got bonds, you've got cash, you've got U.S. stocks, you've got international stocks, you've got private equity. There's 5 kind of broad categories. Are there other categories that should be included in the diversification model?
Yeah, that's a great question. So private investments can cover a lot of things. I would put as their own category, because they're such big asset classes, real estate and commodities. And by commodity, I mainly mean oil and gas. And if you gave me a blank sheet of paper and you give me somebody with $100 million, the way I would break that down is I would have about 70% of their money in public liquid investments, so they can get to that very quickly if they want to or need to. And I'd have about 40% of that money in stocks, both domestic, international, emerging markets, small, mid, large, value growth, very diversified. I'd have about 30% in a very safe, keep your money forever, investment grade fixed income portfolio. Even though I kind of trashed bonds on this call today, it would be very short duration. So there wouldn't be almost any interest rate risk whatsoever. But that's your stay wealthy, stay solvent kind of money. And then the other 30%, I would have in a diversified private portfolio. I'd have it in diversified funds that invest in growth companies. I would have a very, very, very small allocation to venture capital. And I would have fairly significant allocations to real estate, oil and gas minerals, and oil and gas midstream, to where you're very diversified across the privates, because private investments over time tend to perform even better than public markets. And we have a specific expertise in private markets in our firm. So we're very comfortable with that. The problem for an investor is, I think most investment advisors or brokers or banks, they really don't know much about private equity. So you have to be very careful with private investments, and you have to work with people that really know what they're doing there. Okay, coming back, 1 year of cash. Did I hear you correctly? That's what I would have. 1 year of cash? Yeah, that's what I would have at least, yeah. Okay, and George, I think that this has been a fascinating conversation we've had. Give you the last comment. Anything you want to leave us with tonight or today that we should walk away with? Yeah, thanks, Jim, and thanks for having me. And it's really been fun to talk to everybody. And it sounds like we're going to have a sequel, because we got a lot of other questions. So I'll look forward to that. I would just advise everybody out here that, you know, people who are looking for get-rich-quick schemes, and are looking to double their money in the market in less than a year and all that, that's gambling. It just really doesn't work for most people. It's kind of like going to Vegas. You know, you'll read about some guy who hits it big in Vegas, and for every story like that, there's a whole bunch of ladies and gentlemen who go to Vegas and lose all their money. But having said that, patience and a lack of emotion are your friends in the markets. And if you have a long investment period and you have a lot of money that you don't need to access anytime soon, you want to patiently invest in the stock market as prices get lower, and then just put it away and forget about it, and you'll do extremely well. They call compounded interest the eighth wonder of the world. And the reason for that is, as many of you know, that if you put $1 in the stock market and let it sit for 40, 50 years, you're going to have about $300 at the end of that period. So the longer you can invest, the more likely it is you really grow a large pile of money into a mountain. And people should just be real patient and go live their lives and enjoy their lives and let their investments run.
Thank you, George. And if you want to connect with George, you can either get in touch with me, or you can get in touch with Ellie, or you can ask George directly. We will be sending out his email and contact information in the recap that Ellie will send out later today. We have some fantastic programs scheduled in the coming weeks. One is on mindfulness, one is on outplacement, one is bouncing back to what we have referred to as the normal. And then we have a medical perspective on the second wave that we keep hearing about. For all of us at Regeneration, thank you for your time and attention this morning. We're going to get through this, but don't let your guard down now. Wear your mask, wash your hands, and as Dr. Gilliland said last week, sleep is power, food is fuel, and movement is medicine. Thank you, and we look forward to seeing you next Thursday at 10 o'clock.